You ever walk through a city, look up at one of those giant glass skyscrapers, and just think, man, I wish I could own a tiny piece of that? I mean, for most of us, that's just a total daydream, right? Large-scale commercial real estate has always felt like it was in a different universe. But what if it wasn't? Today, we're going to break down exactly how you can own a slice of those massive properties.
So here's what we're going to cover. First, we'll talk about the big problem that kept everyday folks out of these deals for so long. Then we'll dive into the classic solution, something called a REIT, and see how it works and, what the trade-offs are. And finally, we'll get to the really exciting part, a brand new evolution in this space called the SM REIT. Okay, so let's start with the fundamental challenge. For decades, if you wanted to invest in things like giant office buildings, shopping malls, or data centers, well, you were pretty much locked out. This was a club reserved for huge institutions and the super wealthy, because the price of admission wasn't just high, it was millions and millions of dollars. And that question right there, that's the core of the problem. How do you take this massive, incredibly expensive asset, something you can't just sell tomorrow, what we call illiquid, and make it something that any investor can get into? Well, the answer actually came way back in 1960 with an idea that completely changed the game for real estate ownership. And that idea was the Real Estate Investment Trust, or what everybody just calls a REIT. This was the first true gateway, the key that finally unlocked the doors of commercial real estate for the public. So what is it really? Well, a REIT is basically a company whose entire business is owning and usually operating properties that make money. Think apartment buildings, warehouses, hotels. They pool money from tons of investors to go out and buy these properties, and you can buy shares in that company, just like you would with Apple or any other stock. Honestly, this is the perfect way to think about it. You know how a mutual fund owns a whole bunch of different stocks? Well, a REIT owns a whole bunch of different properties. You don't have to deal with tenants or fix leaky pipes. You just own a little piece of the company that handles all of that. It's how you get into the real estate game without the massive headache of actually being a landlord. Okay, so we know what a REIT is, but how does the money actually work? The business model, it turns out, is surprisingly simple. It's really just 4 simple steps. 1, the REIT pulls a bunch of money from thousands of investors like you and me. 2, it uses that cash to buy a portfolio of properties. 3, it collects rent from all the tenants in those buildings. And 4, and this is the absolute crucial part, by law, it has to pay out at least 90% of its taxable income back to its shareholders as dividends. That's not a suggestion, it's the rule. And that mandatory payout is the main reason people love REITs for steady income. Now, it's worth knowing that REITs kind of come in 2 main flavors. The ones you hear about most are equity REITs. They're the ones that actually own the physical buildings and make their money from rent. But then you also have mortgage REITs, or M REITs. They don't own the buildings, they own the debt. They're the ones lending money to buy real estate, and they make their money off the interest. So it's really the difference between being the landlord versus being the bank. Of course, no investment is ever perfect. So let's get real and take a balanced look at the advantages and the potential downsides of putting your money into traditional REITs. All right, let's break down the trade-offs. On the pro side, the wins are pretty big. REITs are liquid, which means you can buy and sell them easily like a stock. You get instant diversification across a bunch of properties, and you have pros managing everything. Plus, you get that steady income we keep talking about. But on the flip side, there are costs. Just like any stock, they're subject to market risk. And because they have to pay out 90% of their income, there isn't much money left over to reinvest for big growth. Now, here's a really important one for investors. That income is usually taxed as ordinary income, which is often a higher rate than what you'd pay on capital gains. And as always, you gotta watch out for fees. So for years, that was pretty much the whole landscape. But very recently, regulators in India have created something totally new that builds on this idea, a whole new asset class called small and medium REITs, or SM REITs. And I want to be really clear, this isn't just a small tweak to the old way of doing things. This is a brand new, officially regulated category. SEBI, which is India's market regulator, has laid out specific rules just for them, all designed to open up a totally different part of the real estate market. It's a modern approach with a whole new rule book. So what actually makes these new SM REITs so different? Well, to get it, let's start with a baseline. For a traditional REIT in India, the minimum investment is super accessible. We're talking just 10 to 15,000 rupees. Just keep that number in your head for a second. Okay, now check this out. This is where things get really interesting. The very first thing you probably notice is that the minimum investment for an SM REIT is way higher, 10 lakh rupees. So you're thinking, whoa, why the huge jump? It's because they're going after a completely different slice of the market. Properties valued in that sweet spot between 50 and 500 crore, a size that was always tough to invest in. But look what you get for that higher price of admission. The rules are even better for investors. They have to pay out at least 95% of their income. And they have to do it more often, every single quarter. And we are not talking about a small niche market here. The potential is absolutely massive. According to a CBRE report, the market for these small and medium-sized commercial properties is expected to be worth nearly 5 trillion rupees by 2026. This isn't a small opportunity. It's a huge, untapped part of the economy.
All right, so let's bring it all home. The big idea is that REITs take these massive, untouchable buildings and slice them up into shares you can buy and sell. Their biggest selling point has always been that steady, mandatory dividend income. And now, in India, the whole concept is evolving. SMI REITs are a new, regulated class, specifically designed to unlock a whole new category of medium-sized properties, and they come with their own unique rules for a new kind of investor.
All of this really leads to a much bigger question, doesn't it? From the original REITs to these brand new STM REITs, we're seeing this clear trend of breaking down huge expensive assets into smaller, more democratic pieces. So, is this fractional model the ultimate future of how we all invest in real estate? It's definitely something to think about.